Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. And as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below before you do anything. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions, or if you need a 15-minute free consultation, just visit Semmax.com or call 336-856-0080. Matt Landon, Jay Tyner, we're talking about 6 habits of successful investors. And let's just jump right in, Matt. Number 1, I think everybody knows this, but let me give you that reminder. You got to start with a plan. Can you imagine hopping on an airplane and the pilot has not filed a flight plan? I mean, you would be like shocked. There's no way we're going to get on this plane and fly somewhere when he hasn't even filed a flight plan. It's really important. How many of you get your GPS, you're getting ready to go to a soccer game, or you're getting ready to go to a new restaurant? What do? You file a plan, right? You put it in the, the Apple phone or the GPS, and boom, you follow directions. Obviously, you would not want to have a retirement without a retirement plan. So I think that's number 1. It's kind of obvious, but I thought I would just bring that up as the number 1 habit of successful investors that we're seeing are those that have a plan. And let me shockingly say that a lot of people that come and sit down, we ask them to see their old plan and they don't have one. Mm-hmm. So you got to get one. All right.
That's true.
Number 2.
Number 2 is to be a super saver. Fidelity, they did a study and they showed that on average, the folks that are going into retirement that have confidence in their plan and that are able to move forward, these are folks that on average are saving 15% of their overall income on an annual basis. Now, that is including an employer match. So if you have an employer that's putting in 3 or 4%, that you can include that into that 15. But that's a good round figure. Some are doing more, some are doing less. The key thing here is the more you're able to save, the better off you're going to be. Now, along with that savings, you can think about savings in 2 different ways. You can think about savings in the aspect of I'm reducing my bills and I'm reducing what I'm spending. But you can also be thinking about saving as what am I actively putting into the market? What am I actively growing? And how can I continue to increase that number? Especially right now, inflation, it's on a lot of people's mind. Well, as you get that cost of living adjustment, go ahead and bump up that increase in what you're putting into your 401k at the same time.
Well, now wait. The Social Security just gave us a big bump up. So are our seniors supposed to be saving, or they get to spend that money?
Something tells me Medicare is going to take that right back. I feel like we're going to end up with a wash.
All right. 6 habits of successful investors. Number 3 is to diversify. Now, I think everybody knows what diversify means, right? Stocks and bonds. Let me give you some other areas that you may not have been thinking about when we talk about diversifying. How about having growth accounts and also diversifying with some income accounts? So those are 2 different ways of saying it. How about diversifying with taxable money and tax-free or tax-favored money? Maybe you should have some diversification there when you look at your accounts. How about this one? How about risky versus not too risky? Okay, and I'm saying that differently, but this is a way to kind of talk in just everyday language, how to diversify. And then the last one would be diversifying in foreign investments versus domestic. Hey, we're not the only party in town, right? There are a lot of parties that happen that you can maybe invest in and see some good results. So when it comes to diversify, there's a lot of different ways to look at it, but I would say, diversify. Right?
Absolutely.
Okay.
Yeah. Along with that, I would say stick with your plan despite volatility. Now, what happens is when markets are green, everything's going up, it's really easy to keep putting money in. Right? It's easy to stick with the plan. It's when all of a sudden we see a downturn that people go, I don't know. It's kind of funny. I think you might have been the one that told me this. The stock market is the only thing nobody wants to buy when it's on sale. When you've got a plan, when we have that volatility, sometimes volatility is up, sometimes volatility is down. It just means there's big movement, there's swings. That's the time you stick with that plan, you stick with the way you have those investments, and you move forward. That's not to say we never look at things, we never make adjustments, but the overall plan, you just need to maintain that throughout.
I like using plane analogies. Like the last time I got on a plane, I think I was heading from Charlotte down to Houston or something, and we get on the plane, and I want to get to Houston, right? That's where my destination is. That's where my plan says I'm going. Well, if it got bumpy, all right, and we're over say we're over the cornfield somewhere in South Carolina, the pilot doesn't land the plane and say, all right, everybody off, it got too bumpy. No, we do a little correction, we do a little this, but what do? We keep going on down there to Houston. That's what we were heading. So I think that's kind of the same thing. Even in volatility, it's like stick with your plan, maybe make some adjustments, keep heading down there to get that
Exactly.
done. Yeah. Okay.
Exactly.
Number 5, consider low-fee investment products. I don't like the word product because usually product means there's probably some stuff built in there. But anyways, if you can do that, I would say maybe mutual funds have a tendency to have more costs built inside them that aren't as transparent as they should be. I'm not saying anything disparaging about mutual funds. I'm just saying that's where we find a lot of costs. Even ETFs can be costly. So everybody is knowledgeable on what a mutual fund is. An ETF is an exchange-traded fund. They can have high costs, but traditionally they have lower costs. So those could be something that you could consider. The next thing might be just to go with an all-stock portfolio and find a platform that has no trading costs, and that's getting down there pretty low, isn't it, Matt?
Yeah.
I mean, that's about as good as you can go.
And I think with that is if you are going to have a small fee, make sure you're getting value for that fee that you're paying. I have people that come in and they'll have 6 things, and not to beat up on mutual funds, but I'll have people come in, they'll have 6 different mutual funds. They're buying the same stuff in all of them. One of them costs them 2%, another one costs them 1/4%. It's like, well, wait a minute, what are we doing here?
Yeah, one fund buys your Apple stock and the other one sells it on the same time, and so you just paid fees and you just kind of didn't go anywhere. And it's okay if you're paying a little higher fee. I mean, I like to have a set of Michelin tires on my car. Right? They're more expensive. I feel a little safer. I think they last a little longer. Sometimes they don't. But anyways, if you want to have a more expensive type of investment, just make sure you're getting the value that you're paying for. And if you're getting the value, there's nothing wrong with paying a little bit more, right?
Yeah.
Okay.
Now, along with that, focus on generating after-tax returns. That is something that I think is key. If you've got every penny invested into a bunch of pre-tax accounts, well, guess what? That tax man's coming. We're going to have to pay that bill at some point. I think it's important. You really touched on that with the diversifying back there at tip 3. Yep. Don't have everything locked up into one way. See what you can do to generate more after-tax money, reducing that overall tax expense. And what you'll find is when you're not having to give 20, 30% to the IRS and to the state, all of a sudden those taxable dollars you need less of it, right? Because what you're netting out is still the same. So I think it's important to be looking at that and paying attention. You can invest one way, cause yourself a big tax bill. You can invest that same account a different way and really save. So are we doing long-term gains? Are we having short-term gains? How do we have this account built out?
And there's so many ways that you can get tax breaks right now. It's just incredible. I mean,
Absolutely.
There's just a lot of different legal ways to not pay as much in taxes. Everybody should pay their fair share, I believe. But at some point, you look at what you're paying and is there a way to maybe restructure that and pay a little less for what you're trying to accomplish. So 6 steps here, 6 habits of successful investors. Start with a plan, be a super saver, diversify, stick with your plan even when there's a lot of volatility going on. Look for that low fee, low cost type of way of structuring your retirement planning. And then finally focus on some tax free or tax favored ways of investing.